Yeah, we attempt to be brief and bright and provide you with some useful insights. I hope that we've managed to deliver on both. I have been picking up the questions that have been posed. So I think we'll start and do it backwards. Nick, there are a couple for you. Firstly, regarding Tesla, will it ever be valued as an automaker and not a tech player? What effect would that have on its share price? That's the first question. And the next question was from Matthew Mattia. Rising interest rates increase the risk-free rate used in DCF calculations. Therefore, as rates increase, so will stock prices re-rate. Have lower rates not simply led to front-loading of the returns that your fund is invested in, since they are high growth and earnings are assumed long into the future? And will we see a slower unwinding of this return should rates go up?
Okay, so the first bit about Tesla, look, the people that hold Tesla are like me. We are believers, and essentially the people who think that Tesla should be valued like a traditional automaker are frankly not setting the price of the share. At the point at which Tesla trades on a similar PE to other automakers in, call it 15 or 20 years, is the point at which you don't want to own the share. I think Tesla's going to look, I think the analogy that I think of is Tesla's going to be more like Apple, where you build this massive installed base, and then beyond that, then it becomes more like a software company, and then you get into the realm of, robo-taxi and other things which are so transformational, not only for the company but for society, and those will be super, super high margin, or it's a pure margin business that you cannot value it like an automaker. You'll value it like that will be the most valuable income stream you can imagine. So I would say no. And so unless you get hard proof, the burden is on the Tesla needs to really, really mess up now. They've got the lead, and now they really, really, really need to mess up for the sort of bear thesis to play out. So I think the probability of that happening is low. On to the second question, low interest rates, could that have theoretically front-loaded some of the performance into last year? There's no way of knowing that for sure. I mean, that's probably possible. I take on board with the point that he's saying in theory, but I think that theory should have held in previous periods too. Clearly, it hasn't. What I'd also say is, my counter would be that I don't think the market ever truly priced in a risk-free rate of 1%. Like, I think the equity risk premium part just expanded. So I certainly don't think that's the case. Look, longer term, if you hold these multi-baggers, your return, and Morgan Stanley's put out some great research where they looked at what drives top quartile performers over time and over a decade-long period, and that's how long I want to hold the best multi-baggers for. The proportion of that's attributable to valuation is negligible. It's next to nothing. The bulk of those returns are driven by the underlying sales growth of the company. So Amazon, Netflix, etc., Tencent, the returns have been driven vastly by the underlying growth of the business and not by interest rates. That would be my response to those.
Thank you, Nick. We'll give you a rest for a little while and flip over to Nolan, some questions for you. From Andrew Van Dam, with the huge excessive money supply, how else would money be devalued if not through inflation? That's the first question. And the next question is about our government bonds. How concerned are you about a default on government bonds or on corporate bonds? Very nice returns for clients with seemingly low risk, but would you be comfortable allocating a large portion to the portfolio at this point in time?
Thanks, Neil. So let's talk about the devaluation of money. And I actually spoke at the Where Will the Money Be Made about a year ago, where we said, look, there are a lot of factors that feed into what happens to that money. It's not necessarily always a case of you print money, it becomes inflation. Certainly, if you print enough of it, you will get there. I think Zimbabwe and maybe Germany in the 1930s proved it. However, as we stand right now, our historic experience with quantitative easing has been that, within the realms of normal quantities, which we can debate, that what you end up with is the velocity of money slows down. In other words, you print more money, but the money gets lazier and lazier. So it just circulates around the system slower and slower. Reason for that is probably that a lot of the money gets spent on investment. So what we've seen is investment portfolio inflation, spectacular investment returns, but you haven't seen real economy inflation. And the question is, will you ever? And at this stage, if the experience of the last decade is anything to go by, probably not. As long as that money that's slowed down around the economy remains slow and it doesn't all sort of leave investments and move into refrigerators and television sets, then you're unlikely to see this surge of inflation, and it's been absorbed by investment inflation. Turning to South African bonds, are we concerned about defaults? As a fixed income manager, you're always concerned about defaults. We spend an inordinate amount of our time in credit committees chewing through who we invested in, what are the actual risks. Looking at the corporate South Africa, obviously has been under pressure for a while. From the perspective of the portfolio, there's no one that I'm sitting here completely unraveled by, uncomfortable with. I think we've generally leaned into higher quality companies that are, broadly speaking, blue chip. So, African Bank, for instance, we avoided entirely, and that has served us well over the years. So we're comfortable with our portfolios. Extending that question, are we concerned about it? SA government bond default? Look, South African government bond quality has reduced. We have definitely seen a quality reduction, and that's evidenced by the credit rating downgrades. It's also evidenced by the increased cost of insuring against defaults in South Africa. That being said, our most likely scenario, or 2 points. One is that the fundamentals in South Africa are actually getting better right now. So, our maximum debt level is probably come down. I wouldn't be surprised with commodity prices having done what they've done, if next time the Minister of Finance speaks, actually things look a little bit better again. So we're seeing a positive outcome there. That being said, can we use this to sort of turn around the ship and right the things fast enough? Time will tell. But the most likely scenario, if it goes wrong, is that it's a slow bleed out scenario whereby, gradually our cost of debt gets more and more, our debt burden gets more and more, and the minister keeps spinning plates for a long, long time. In that sort of environment, bonds are still going to be healthy investments for the next decade anyway. So at this stage, it's not something that we really are agonizing about, particularly in the team. I think it's if something goes wrong, it's probably too far out for us to really get excited about. Last question, I believe in diversification. So would I take all of a client's investments and stick it in the bond fund? Please don't do that. You need growth assets. You need to try and diversify across asset classes. I do think for a client that needs to achieve a sort of 7-ish% return, a bond fund actually should represent a significant proportion, maybe half of the investments. But don't disregard the other asset classes. There's a lot to be said for diversification.
Thanks, Nolan. And some stock-specific questions. Maybe, Pete, if you could pick them up. Disney Plus is only currently available in select markets and not yet global. Will that not slow the subscriber growth of Netflix once they open up to the world? And then another one on Netflix, which is kind of related. How real is the risk of access to content with guys like Disney moving into the space? So those are the next Netflix questions. And there's one on Amazon. What is the possibility of an Amazon stock split? If it occurs, will the upside be higher than present?
Yeah, so I mean, Silo, you can add to this if you want, but from a Netflix perspective, I think the massive appetite and take-up of Disney Plus, which is now sitting at, well, Disney as a whole sitting at around 100 million and projecting 350 million users by 2024, is an indication of the appetite and the potential market out there. Now, I think, as Nick was saying, on pay TV in South Africa, people were in many cases, are prepared to pay R1,000 for a DSTV package. These products from these suppliers are coming in at kind of 150, 200 Rand each. So we think certainly in higher LSMs or in other parts of the world, you'll end up seeing people have a few of these packages. The space is becoming more competitive. I think what Celero showed you is Netflix is outspending the others, and you get that beautiful benefit of critical mass. Where your R1 million spent on production now goes across 200 million subscribers, and next year it goes across 220 million subscribers, etc. So I think there's space for everybody, or space for 4 or 5 big players. That's what we build into our models. From an Amazon perspective, a stock split is a distinct possibility. We have seen theoretically, as most of the viewers will understand, a stock split doesn't increase the value of a company. It's one pizza which now has more slices. But when the market is in a bullish mood, you have often seen that impact the price positively. And you've seen it with a few companies over the course of the last little while. Yeah, that's
just to add on Netflix. I think in a way you could say that Disney is almost the exception that proves the rule, in the sense that Disney is very unique in that it has the scale and the brands and the content to provide a viable competitive offering, whereas some of the smaller offerings that you saw in that table with the subscriber numbers, they just don't have the scale to really compete with Netflix or Disney. And so they end up having to sell a lot of their best, or license a lot of their best content to Netflix, actually.
Thanks, guys. We've got loads and loads of questions. I'm afraid we're running out of time. We're not going to have a chance to answer all of them, so I'll deal with 1 or 2 more. Maybe just to say, because the questions have come through, we will be sending out a copy of the slides, or at least links to a copy of the presentation and the slides post the event. Probably only happen tomorrow because we've got to sort of tie it up and edit it before we send it out. Also, your CPD points, you don't need to claim for them. We will mail those out. That process takes a bit longer. For those of you familiar, we need to apply for the points from the FBI. That takes a couple of weeks, and once that's all done, we'll mail all your certificates to you, so you don't have to necessarily do anything. I will deal with 1 or 2 more questions. First, from Janice Roberts. There have been media reports that President Biden plans to increase capital gains tax on wealthy Americans to about 40% from 20%, at least 39.6%. If this occurs, how will this play out for US and world markets? Don't know, Nolan, can I throw that one your way? Or Pete?
You can indeed. Fortunately, I was actually reading research on this yesterday, which says it was a rather sad Sunday. So specifically, it's not media reports. It's actually a reasonably concrete plan. But the key factor to note is that President Biden's intention is to tax individuals. He's not raising the capital gains tax on corporates. So it's individuals, and specifically your wealthy American families. Estimates are they've got about $1 to $1.5 trillion of capital gains that haven't been realized. How does it play out? Well, theoretically, individual tax has a very limited impact on corporate valuations, and that's what you'd expect to see. So there's very little theoretical impact. Practically, if you look at previous times that the US has raised capital gains tax, what you've seen is in the quarter where they raise capital gains tax, equity prices come under a little bit of pressure. Maybe people take the view of I'd rather pay 20% now than 39.6% in 3 years' time. Sort of makes sense. And they therefore, crystallize some of the capital gains. It tends to be a very, very short-lived phenomena, and then the markets tend to recover. So it's going to have a very limited impact from that perspective. From the perspective of broadening the US tax base, from the perspective of using that to sort of repay some of the debt, I think that's quite positive for financial markets in the longer run.
Thanks, Nolan. Right, let's take 1 more question. This one comes from Michael John Dippenaar. On your asset allocation breakdown, both international and local alternatives were highlighted as high growth and anchor asset allocation areas. Would you care to elaborate on the strategy on a macro level and options available from anchor? Peter, if I could ask you to deal with that one.
Yeah, sure. So it's a space that we've always backed and had a play in. With valuations pretty high, and we think a lot of companies price for perfection. We think alternatives play a valuable role in an asset allocation mix, and there's space for kind of 5 to 20% in the alternative space for a high net worth individual specifically. So our kind of flagship fund is the Anchor Accelerator Fund, which has delivered kind of 15% plus compound returns year in, year out for quite a few years. It was the top long short fund in SA in 2019 and right up there in 2020 with returns of 30% and 19%. So it's just a different tool set where a fund manager has the ability to make money out of markets going up and down and not necessarily just out of long only shares. So we think it plays an important part of a portfolio. We've got a long-standing, well-established, great-performing team in that space. So for anybody who wants to talk more about alternatives, it's certainly part of our armory and part of our belief in how you achieve returns over time.